Alrighty guys, welcome back to the best investing money management channel on YouTube. In today's video, we are going to be talking about why the stock market is crashing, 2, how to prepare, 3, how to profit off a market crash. So hope you guys enjoy it. If you guys get anything in value out of this video, hit that like button, subscribe to the channel. If you have any questions, concerns, make sure you guys ask them down below. So kind of what's going on with the market. Okay, if we look at it, you guys will notice a couple of things. The very first thing is right in here. This is our last crash we had. This was in March of 2020. Now, during this time, this is when pretty much all the lockdowns happened. There was a lot of emotion, a lot of fear, which caused the general market to sell off about 37%. Okay, it hit all the way down here at $212, immediately got bought back up within the next couple of months and was hitting highs. Okay, during this time in here, there were still lockdowns. There was still supply chain issues. There was inflation was slowly starting to creep up. And on top of that, unemployment was pretty high. Okay, things just kind of continue to rally up, right? There was high inflation, government was printing money, and everybody just had a lot of stimulus and a lot of leftover money, which caused housing to go up just because there was so much money out. And then we hit this price up here at about $478, where the market started selling off. Why is that? Well, right now we do have very, very high inflation and high interest rates. So those two things are pretty much just a go-to for fear, for emotion in the market. Anytime you have high inflation and high interest rates, people get a little nervous about their money, right? And that's kind of what we've seen. We've seen a decent sell-off of about 17% from about $478 under $400. Okay, so pretty much if you would have bought this stock or bought this, bought into the market, because this is just the S&P 500 ETF, if you would have bought this at the beginning of the year, right now you're actually down 17%, which if you think about it, 17%, the market averages a 10% return. So you're looking at a 1 year of investing that you've got wiped out. And that's just only to break even. So if we look at it, you guys will notice that it did have some decent support right here at about 415. Okay, it hit it several times, right? Once, twice, 3 times. And then we had this where it kind of started to consolidate, right? Where the market wasn't doing much, a lot of up and down, and then this massive sell-off where it broke below 400. And now this is what makes me nervous about a possible crash, right? The reason why I say that is because we're starting to have this stair-step effect, okay? So pretty much what that means is the lows are getting lower and the highs are actually getting lower as well, which is what I call it the stair step. Okay, so it's starting to stair step down, and anytime you see something like that, it really changes the direction of the market. And that's kind of what we've noticed. The market, a lot of tech stocks in general have been hit very, very hard. But another thing you have to realize is what goes up must come down, right? Over the past 2 years, we've seen the S&P 500 hitting highs. It was up, 30%, 40% in some cases, where if you'd have bought down here or even in here, you're up handsomely on your investment. But the thing that you have to realize is what goes up must come back down. On average, we get a market crash every 3 to 6 years, right in that range. So given we're almost getting to that 3-year mark in the next year, because we're probably at the 2-year mark, I definitely think we're due for a possible crash or correction. A correction is a little different. It's when the market sells off 10%, which we've already seen. It's just a matter of, is the trend going to continue? So how to prepare. Now, there's a lot of things you guys can do to prepare. The very first thing that I think is beautiful is to have cash, right? Have cash, and if you already invested, don't sell your stock, especially if you're a long-term investor. Don't sell your stock. The reason why that is over the past 90 years in the general market, it's gotten an average return of 9.8%. Okay, so through all the ups and downs and volatility that we've seen, if you would have just stayed invested, you're making money. Timing the market, it's better to have time in the market than try to time the market. That's what you have to realize, right? And not to mention, holding cash is the best thing. The reason why is because when you hold cash, you can buy at very, very good pricing, right? During this crash, imagine if you'd have bought down here or in here or even in here, you're up handsomely on your investment. given that we've seen some sell-off, I would start to dollar cost average back into this, start buying as much as you can, because you understand that it's not going to last forever. It's not. I don't care what anybody says. Recessions happen and then they turn into bull markets. Just like in here, just like in 2008, just like, in the Great Depression, right? We've seen turnarounds, and that's kind of what we will see. We will see a crash. Probably it could be a year or so of just consolidation, but as long as you're buying those up, once this thing recovers, you're going to be making a ton of money. And that's how you guys can make a lot. The second thing is hold dividend stocks, right? Dividend stocks, companies like Johnson & Johnson, companies like Home Depot, companies like Coca-Cola, companies that are more value rather than growth, do perform better than growth stocks in the market. The reason why is because people are more likely to hold companies like that are paying them dividends and that are actually still making money. Companies like J&J, Johnson & Johnson, if we look at the chart, you can see we've actually seen a buying pressure step in compared to selling pressure. Companies like Waste Management that handle, waste. Actually, we've seen an upward trend. As long as you understand kind of where you can put your money, you will be fine. And that's what you have to understand, is just continue to invest, but now start dabbling in, some more value stocks. Companies like I mentioned, Johnson & Johnson, Waste Management, Coca-Cola, all of those, you will make money. You will continue to get dividends, and hopefully you guys can get a decent amount of growth off them. But that's kind of what I am doing. Another thing you guys can do for a risk-free investment is right now the government's offering a 9.6% interest on your money when you buy savings bonds. So for me, I threw some money in that, and I'm not even going to look at it. 9.6%, it's a no-brainer. It's almost as good as the market. So that's kind of what I'm doing and how I can try to make some money off this. But guys, that is it. Hope you guys enjoyed it. If you did, hit that like button, subscribe. We will see you guys later. Remember to stay happy, guys, stay positive, and stay safe out there. We'll see you later. Take care.